So welcome to this community talk about Maple Finance by Tokenomics DAO contributor John. He has written a Tokenomics 101 article about Maple Finance, and he's going to tell us all about that here in a minute. Tokenomics DAO is the internet's largest tokenomics-focused community. We do all kinds of cool stuff, including, but not limited to, producing tons of high-quality content. For example, these before mentioned Tokenomics 101 articles. We also blog about the creation of our own token and the tokenomics thoughts that go into that. We record podcasts, we do consulting projects, and most importantly, we're building tools for others to use to do their own tokenomics and to learn about tokenomics. And so most notably, we're currently developing Tokenomics Hub, and that is a place where you can see basically a standardized overview of the tokenomics of protocols that have signed up to it. Signing up to Tokenomics Hub is completely free at the moment. We're trying to get the amount of listed protocols up. So if you want to join this community and do something that people can see and build your own reputation in the space, then consider taking a look at Tokenomics Hub and starting to contributing to it. So without further ado, John, I'd like to give you the mic, so to say, virtually, and you can take it from here. And as I said before, I'm going to be tweeting out some visuals under the space to go along with what John is talking about. And John, I'm going to interrupt you here every couple minutes just to a little bit summarize and ask questions if I have any, because it turns out that that's good for the algo here on Twitter. All right, take it away.
Well, thanks for the intro. This community talk, I guess, we kind of discussed, but it's about the Maple Finance platform and the token. So just going through the agenda, we'll be, covering Maple Finance platform, what it does, how it works, go over the native token Maple, and kind of summarize how, the token ties everything together. And then we'll also be looking, I think, at specific aspects of the tokenomics. I like to talk about the distribution and allocation, go over the value capture and creation, and then I guess leave some time for Q&A. Yeah, so to kick it off, I guess, Maple Finance, if I've had to summarize it in a simple sentence, it's a decentralized corporate credit marketplace founded by, folks coming over from TradFi. But I think essentially the platform is financial infrastructure to facilitate under-collateralized lending in crypto. So this is pause there. Like, I think, in the last 3 years, most of DeFi lending activity has been over-collateralized. And so making this transition to under-collateralized lending, in my opinion, is a really big unlock in DeFi. It's a new key primitive that has a few things going for it, right? I think for one, over-collateralized lending in crypto today is the use case of that is still very limited within the crypto ecosystem itself. I think most loans that are used are really done for to lever up and speculate, and you can kind of see this playing out in a bull market where demand for loans on compound RV for any stable coins were as high as 8-10%. Now in the bear market, there's less leverage for loans. You see yields on compound RV are like 1-2%. So that's caused a lot of I think retail to look for higher sources of yield, especially when you have treasury yields paying out at 6-8%. And I think the other big thing is that under collateralized lending is helping to grow the overall economy of DeFi. It unlocks TAM that's potentially allows it to tap into other industries outside of the crypto market, and it also just grows the overall ecosystem within it. So I think I'll probably be talking more about the value creation later on in the slides, but I guess to kind of go more into detail on what Maple Finance is, it's easier to best understand it through the lens of the key participants in the platform. So you have many other lending platforms. You have the borrowers. In this case, they're mainly institutional companies CeFi, trading firms, market makers that need access to capital but can't really get it from traditional banks. And then you have the depositors, mainly retail, that are looking to get some higher yield versus your 2 to 3% on like an obvious compound, or they can't access, they have most of their money and capital stored within the crypto ecosystem. They can't access the yields, the bank yields outside of the crypto ecosystem. So that's kind of the main, those are the main participants. But I think what Maple Finance does differently is they introduce new two key stakeholders that you don't necessarily see in like other like lending borrowing protocols. And that's really due to the new additional risk that is kind of brought in with under collateralized lending. So you have like these people called pool delegates. They're essentially the underwriters. And then you have pool cover providers who essentially provide insurance against any loan default. So that's kind of the overall platform. I'm happy to kind of go more into detail there, but I guess I want to pause and see if any points of clarification that I can help to talk about.
Yeah, guys, and just to reiterate it, if you guys have a question, you can request to speak, and then John or I can give you permission. You can ask your question. You can also tweet a question if you like, and then hopefully I'll see it and I can ask the question for you. But yeah, so just to recap, John, it sounds a lot like there are more or less replicating I guess like a bank's effort to create a loan, but they're doing it in a DeFi protocol. Would you say that's more or less correct?
Yeah, I mean, I think one point of criticism that people have with platforms like this is still very centralized, right? All of the lending is still facilitated through underwriters, and there's still a pretty high point of centralization. But I think the key point here is that it's very difficult to do under-collateralized lending in DeFi otherwise, right? I think for under-collateralized lending to work, you need to be able to assess the credit risk of the borrower. And if people on DeFi are borrowing, it's obviously open source, permissionless, a lot of times anonymous. So how can you actually assess that credit risk unless we have the equivalent of a FICO score or a social reputation? But those kind of primitives are still not being built out. So I think Maple Finance is in sort of way like a kind of compromise, right? You're bringing in elements of traditional finance lending, but then just deploying it on blockchain rails with better transparency, better speed, and I think new incentive mechanisms through the token that we'll talk about later.
Yeah. No, I think it makes complete sense, right? Because as a lender, you do want to. As a lender, essentially, you're always managing a portfolio of risk, right? And so it makes sense that you must have that point of data if you want to loan somebody on an under collateralized basis. If you're buying a car currently and you have to finance it, then either the car dealer or the bank that finances it needs to know who you are to have an idea with how likely it is that you won't pay it back, and that directly translates into the interest rate that you're paying, right? So if there's a higher risk of default, they'll charge you more, which is of course a little weird because you have no money, I'll take more of your money, but that's how it works, right? That's finance. So I think the point that you touched on, that this kind of credit score system doesn't really exist yet in crypto. That's actually also a really interesting thought. I think I wonder how that would be possible to build sort of a credit worthiness rating that's anonymous, right? So just based on interactions on the blockchain. But this goes a little besides this. I just thought it's an interesting thought. Anyway, please continue unless somebody else has a question. You can request to speak at any time, and we'll pull you up here. Keep going, John.
Yeah. So I guess that's the platform itself. Really, to summarize, you have retail depositors that are really lending out to CeFi institutions that lack access to capital, and so it's kind of central to that whole flywheel happening is the Maple token. I think to date, the platform has facilitated over $2 billion in loans, mainly to trading firms and market makers. And we'll kind of go a little bit more in detail there of what my thoughts on the borrowers are. But essentially, the Maple token has two main functionalities. If I had to summarize it, number one, it's a it is used as a token. It is used to improve and enhance the platform and underlying product, and it does this through token incentives, and it does this through product feature enhancement. Right, so. And then the other one is just the direct utility to the users and token holders. So just kind of go through each one. For platform enhancement, I think the most powerful feature of using Maple is that you can use it as an incentive reward to incentivize different behaviors on the platform. And that's kind of important, especially in marketplaces where you need to either first develop and encourage supply, and then further on facilitate and encourage the demand side. Right? I think Maple is also unique in that it's used as collateral insurance. They do this by requiring any underwriter to basically deposit and hold Maple, put it in a separate pool. So in the case of a loan default, then these collateral tokens end up becoming the first loss capital. And then finally, obviously, you have a Maple that's used as a governance token, which helps to decentralize the protocol, give ownership, so forth. I think the other side to think about Maple as a token is the use of Maple as a value capture token. So one way that the protocol helps to make sure that any growth in the network is distributed to users is through revenue sharing. So mostly this comes in the form of paying Maple tokens to stakers. So those who stake Maple get this staked Maple token called MPL, and essentially the protocol uses about 50% of the revenues that are generated to buy back Maple in the open market and distribute it back out to users. And then finally, I think the last perk is that it gives you some access to enhanced features. So in the case of Maple borrowers, those who are holding Maple get basically access to additional discounts on the borrowing rate. So just to summarize, right, Maple is used to enhance the overall platform by use of incentives, features like collateral decentralization, and it also has utility to users through revenue sharing and perks. And we'll kind of go through more into detail with how this overall platform works in a diagram later, but I guess I kind of want to stop there and open it up for questions as well.
Yeah, so we just had a speaking request, but then it kind of disappeared. So I'm trying to see if Enter said wants to come up here. I just sent an invite to speak again. Nope. Now he left the space altogether. I don't know if it's a technical issue or not. But so anyway, I don't know if people use this on their computer or not, but the features of Spaces only work on your phone, which is a thing sometimes people miss, and then they try to do something other than listen, and it doesn't work. But yeah, anyway, so you were talking about the Maple token and how it kind of serves the platform.
Mm-hmm.
And basically, two key things are that it enhances the products and features of Maple, and it also serves as an incentive to users.
Mm-hmm.
And yeah, I think that makes sense. And and Andy said it serves as a like a backup collateral for loans.
Yeah,
Is that
exactly.
What you said?
Yes, yeah. So I think that's obviously with undercollateralized lending, you need to have a way for those that are underwriting to be able to have some skin in the game, right? So I think what
Right.
Maple does that is interesting is that it requires any sort of underwriter to buy some Maple tokens and put it in a pool in form of a Maple USD liquidity pool. So I guess does two things. It increases liquidity for Maple in the event of a loan default where they have to like sell Maple in USDC to raise funds, and also like helps to provide some of a buffer in the case of a default. I do have some thoughts here on insurance. I think there's probably more improvement to be done in terms of having that percentage of the overall like loan go up, so there's more skin in the game. But I think it's a good start in terms of like the lending model and how it can be used to like make lending safer.
Yeah, I think the principle is definitely good to have the have people that make decisions have skin in the game, and so hopefully, so you're hoping to align everybody's interests and the underwriters to underwrite. I mean, a good amount of loans, because with more lending activity, the value of the whole thing is higher. But then, of course, not take any undue risks and put everybody's Maple token in peril, right? Because if they have to liquidate Maple to cover a loan default, then the price of Maple is going to go down, right? Because they're going to sell a chunk.
Exactly.
And yeah, I think it's a good idea. And there's a similar mechanism in MakerDAO. Actually, I think the different scenarios play out, and Maker token. There's a chance that Maker token can also get liquidated in case of default. Although the lending model there is different, but I think the incentive behind it is similar, at least on the surface.
Yeah, and I think a good comparison to make is like you compare it to the centralized platforms and how they lend money now, right? Like Gemini Earn, Celsius, BlockFi, they should have been like required to put a form of buffer, right, for users, so that if they're lending out users money, then they should be lending a percentage of their own balance sheet, right? It's just maybe like not a perfect comparison, but I think it's all about incentives, and I think that's why like having Maple token is interesting, right?
For sure.
But over the last credit cycle, I think also important to be a little bit more neutral, right? There has been like loan defaults on the platform. Notably, there's one underwriter called Maven that underwrote to a trading firm that ended up having they had exposure to 3AC, and a lot of this centralization still means that there's room for the same sort of fraud and misappropriation. So I think the Maven pool ended up having some loan defaults. They had only maybe less than 10% in pool cover for the amount of loans that were underwritten. So there's still improvements to be made in the model, but I think the idea is that you have this new, like tokenomics as a field is still very new, right? People are still iterating. So I think this is like a good start.
100%. I think. Well, and I think also the intention to align incentives on Maple side, I think, is definitely positive. And then, the way I look at tokenomics, it has to kind of evolve over time, just like a product gets updated over time. And so I think on the surface, it sounds like they're on the right path. And then, we're going to dive deeper here into the mechanism, right? With the next thing is the tokenomics diagram.
Yeah.
And I think at least a chance that they'll figure this out is right. But so one thing that you've touched on before, so Maple wants to work with institutional customers, right? So that they don't go to consumer.
Exactly. So
yeah,
because I think because they're lending to institutional borrowers, then they're able to underwrite them properly and assess credit risk, right? So that means it's very similar to a normal like due diligence process where they have to like submit their financials. Obviously, all of them are KYC, KYB borrowers. That means they're like real businesses. They've done the legal checks, and so they're still subject to legal recourse if they don't pay back the loans. Can still be like Maple and like the underwriters can still pursue like legal action. So I think that's one thing. And then number two, like because they're businesses, because they have financials, then you can assess their ability and to pay back the loan, right? Basically looking at cash flows. But I think one criticism I would have is that most of the loans nowadays are being extended to trading firms and market makers. And while that is to a certain extent like important in the crypto ecosystem, like a lot of that money is still like being used, like for at least for the trading firms, being used to like over lever on the market, right? So what Maple intends to do in the future is to extend it to fintech firms, or maybe even just companies that are higher up in the risk profile that would otherwise not have access to traditional lending from banks. So it is a good step in the direction, but I think there's also like some criticism that you're ultimately still lending to participants that are just like betting on the market, right? So is it really true value creation? And I guess we'll talk about it a little bit more there later on.
Okay. Well, I like how you weave in your commentary. It's usually I have to ask the authors to give some points of criticism or feedback on what they think about it, and I really like that you're weaving it in. So yeah, keep going.
Yeah. So I guess next one, go through the diagram. It is a pretty complicated like diagram, so I think I'll try to simplify it to the best I can. But essentially, looking at the business model, like because it's a lending business, all revenues really come from two avenues. Number one, interest income. Number two, like origination fees. And then there's a split between a number of stakeholders, right? You have the lenders, the retail users that get the majority of the interest income and origination fee. You have the underwriters to get the remaining a good percentage of that fee. And then
John, sorry, let me interrupt you really quick because I know you're talking us through the diagram, and I'm really sorry, but Pranav just requested to speak and I think wants to ask a question really quick, and I assume it's on the previous topic, so that's why I thought it makes sense to get to it really quick.
Hey John, and hi guys. It's actually quite an evening in my place. So yeah, let me come to the point. So here, Maple Finance is something similar to what Ribbon Lending is also doing, wherein there's actually some credit rating or something done to a company. So once again in this concept there might be something similar which happened in 2009 2008 to Credit Suisse happening over here. So it's not like it's easy to say that the funds or something are safe, because like you also mentioned that there was a lending issue and there was one liquidator issue and all. So how far it is scalable? It is once again bringing all the centralization part and things like similar to a bank or something, some lending institutions, again into blockchain, wherein only like the borders are free. So anybody from any part of this world can invest into their fund and they will lend it to somebody. So how far this is scalable, apart from the fact of retail investors getting onto this institutional lending activities, anything different from what we see in the real world?
Well, I think the main key point here is that you're opening up access to the corporate credit market, right? So today, like if the average user wants to invest in corporate bonds or have some access to the yield that is otherwise generated at a bank, that's not possible, right? So I think the credit market is like a $20 trillion like TAM, right? So if users, I think that the main like value add is that you're allowing users to get access to this new asset class, and then on the opposite side, you're opening up for companies. Now they get a new funding source. They don't have to only go to the bank, but they can go directly to users.
So
And
apart from
I think for sorry, go ahead.
no, you can continue. I mean, we're also like we are on the same line, so it's
Yeah.
fine. Yeah.
And then I think the second point is that this is only as scalable as the number of underwriters that come to the platform and are able to underwrite. But I think the key point here is like Maple Finance, it's not the one that is underwriting the loan, right? It's you have to think about it more as a technology platform. So maybe in the future, all like institutional lenders will come into Maple Finance because the platform is more transparent, right? You can see who you're underwriting to. You can see the total amounts. I think that has really helped during the most recent like bear market and credit crunch, where people who are investors or depositors in the Maple pool can see the loans that are like who the recipients of the loans, right? And so as you're seeing like the news come through of like potential issues with like this like with 3AC, they can see people who are have some exposure to 3AC. They can tweet, they can discuss in Discord, and that puts pressure on the underwriter to be acting with more care, because retail can see exactly who they're loaning to. So I think that's kind of the value add. I mean, I don't want to go too far ahead, and I hope that addresses your question on how it scales and how it's different. Like,
Yeah, that's I mean, my point of thing is discussed, and it's something like we are on the same track. So according to me, this seems like a great thing for retail lenders and retail people to get onto some really huge market and make some quality and something a safer return rather than getting into some other thing. But I don't know how far this can scale, and what's the MPL token value as an investor, and what is the MPL token gonna give? Because there's nothing something like a DAO governance, like whom you should lend to thing and all happening in the Maple Finance side. So might be if that would be helpful, like somebody like we know this Credora, right? Credora, the credit rating on chain. So if that company comes up and gives some credit rating like any credit rating bureau, it would be helpful for people slash the DAO mechanism to lend things and earn return to investors directly.
yeah, but I guess then that brings up the question, like, does the average user have the ability to like underwrite with the same, like, I think, ability as like professionals? And number two, then that also just leaves all of the assessment and credit risk assessment to that specific credit rating, right? And we all know that that's not necessarily like that still leaves a certain degree of like centralization and trust within one party, right? And unless the credit rating or the rating agency has incentive or a stake within the protocol to make sure that they're not rating these like companies on like inappropriately, as we saw what happened in 2008, or also how like they're able to just rate all the private companies, all the companies in the world that want access to financing, right? That also introduces a level like another question on how this scales. So there are a lot of like problems within the space that I think that need to be addressed with every single like model.
Okay, John, let's move on in the presentation. Thank you so much, Pranav, for your question. It was a good discussion.
Yeah. So I hope people can see the diagram because it's very small and there's a lot of things going on. But yeah, essentially you have, I think I mentioned before, revenues come from interest income and origination fees. these are paid out to lenders, underwriters, like the pool cover providers, which I call it. Just make it simpler. The people who are providing insurance, and then the holders, basically the investors in the protocol that get a portion of the protocol fees in form of distributed Maple staking rewards. But there's a lot of things going on here. I don't know if everyone has it open up. How you usually go through this diagram, Lovis. Or if there's any.
So I tweeted out the diagram again, and I added the link to our Tokenomics DAO website, where you can also find a zoomable version of it. And I would recommend that you go through it just kind of by the step-by-step on the bottom, which I'm sure you included. And then, I mean, there's a lot going on, so covering every single aspect of it is probably not possible, but maybe you can talk us through the key points that are also outlined there on the bottom with this. That's with start here. With start here.
Yeah, so I guess with any like token genesis event, right? The protocol decides how many tokens they want, how they're going to allocate it across the participants. We'll talk a little bit about it in the next slide, but you have a portion that's distributed to the treasury, a portion that's directly or distributed to insiders. That's like the team, the investors that are subject to a vesting schedule, and then a portion that's sent out to liquidity mining incentives to kind of bootstrap the protocol. So now those initial Genesis tokens are distributed. How does everything flow together? Well, you start with the treasury earning 67% of the loan origination fee. So for any loan that's distributed, the lenders charge an origination fee for every single loan, and then they also make money from the interest income, right? The interest that is earned from that is paid and earned. The treasury takes a portion of these protocol revenues, as mentioned, like 50%. They use it to buy back Maple from the open market, and then they take those tokens that are bought back and then they distribute it out to stakers. And so that's kind of the way that Maple accrues value, and why there's a reason for everyday like retail user to buy Maple, who is not necessarily depositing capital in the protocol, but just wants to have some appetite to thing itself. There's a lot of mechanisms in crypto nowadays that use the similar mechanism to distribute value and capture value. We'll kind of go about it more in the last slide, but I also do want to just point out that all of this ultimately just becomes like a design exercise to make the token seem like function as much as a security without actually being a security, right? Instead of paying out a percentage of the interest income or the origination fee in the actual like ETH or USDC, they're just using it to buy back Maple from the open market and then distribute out in staking rewards. So that's like a common criticism that I will make and want to point out when it comes to crypto. A lot of it's just like legal arbitrage, and who knows, right? Maybe one day the SEC, if Maple becomes big enough, that's a point of risk for the team and for the users as well. But I'll stop there and see if anyone has questions.
Yeah, I think that's what a lot of protocols are trying to do, is function like a security without being one. I like the term legal arbitrage you used. I think that sums it up pretty well. And yeah, as far as mechanisms go to capture value, I think that buying your own token with part of your revenue is definitely shows a sincere commitment of the organization to the token. But it's surprise. So but it depends how powerful it is, right? At the end of the day, I don't know. This is me. This is my opinion, right? So I don't know. I learn these things as I go as well. But it seems that, so I think the token buyback is a good incentive for sure, because it means more revenue, more activity will create more money flowing into the token on the buy side, on the demand side, which is always the harder part to figure out than supply. And but then at the end of the day, you need to figure out reasons why the people that own the token want to keep it and not sell it, right? And the answer cannot just be because staking reward, because we've seen time and time again that that's not enough, right? People will unlock or will unstake and sell if push comes to shove. So there needs to be kind of a more long-term reason. But this is true for, this is a high-level comment. This is not specific to Maple. Yeah, other than that, anybody have a question, feel free to request to speak and we'll get you up here. And otherwise, I think, John, keep going in your presentation. I think it's very good.
Yeah, so the next portion, I think probably the most important step for any project is to think about their go-to-market strategy when it comes to the token genesis event. So for Maple, they decided to distribute 5% of the Maple to the public through Balancer's liquidity bootstrapping pool, essentially an auction mechanism for people to be able to buy the token in the open market. But they raised about $10 million, attracted about 1,000 participants. So I think with that total amount of money raised, essentially, basically assumes like a fully diluted valuation of like around 200 million. In my opinion, I look at Maple, I compare it to the the other competitors. This raise the question, was this go-to-market mechanism, the best one they could have approached? 1,000 participants, it's not that much, especially for a marketplace that requires a lot of users to deposit a fund. So maybe if I'm looking through their initial token allocation, they could have allocated more to their more supply to their TGE for the balancer pool. I guess also begs the question, would that increased supply have been met in the open market with people that are trying to buy the token? Maybe they could have thought about an airdrop or just an extended liquidity mining program, right? And I think that's a really powerful aspect of token incentives, right? I don't know who here is involved in the NFT space, but you can kind of see how powerful this can be with airdrops or vested airdrops. Whether it's optimism or with the recent Blur marketplace, people will be very engaged with the promise or potential of having token incentives just from driving activity, right? And while people can say that this is not super sustainable, it helps to at least jumpstart the cold start problem very associated with marketplaces, right? And so they only allocate about 30% to liquidity mining. I think a lot of other protocols these days distribute more. So I think the point I'm trying to make here is that, in my opinion, with marketplaces, there needs to be more that's allocated from the token genesis event allocation to incentives to drive network effects, to drive activity on the platform, and maybe just increase the public auction or initial supply that's available to the public. But I'll stop there and see if anyone has questions.
Yeah, guys, if you have any questions, feel free to request to speak. We'll get you up here. John is doing a wonderful job summarizing and walking us through the key points of tokenomics of Maple Finance. A couple people just joined, so I'm summarizing a bit. Maple Finance is under collateralized. Say that 10 times fast. It's hard to say. Under collateralized lending platform for institutional borrowers. And you were just talking about the distribution and allocation of Maple token. And so in essence, Maple raised about, what was it, 10 million from 1,000 participants.
Yep.
And distributed token, and that comes to a fully diluted valuation roughly of 200 million for the Maple protocol, I guess you would say, or for the Maple token. And yeah, any questions you guys have, feel free to request to speak. Otherwise, you can also tweet out a question and I'll try to catch it.
Yeah, and I think when I was thinking through like whether or not this was the right allocation amount, like I looked at some competitors that are doing similar in the space with undercollateralized lending. I think the two main ones are Goldfinch, TrueFi. Both have hired users, and I don't think it's a coincidence that the allocation to like liquidity mining incentives are higher, and that they're still paying token incentives. A great resource I like to use is Token Terminal. So you guys have your computers up. You go to Token Terminal, you search up TrueFi or Goldfinch and Maple, and then what I like to look at is you go to key metrics. You can take a look at token incentives, and you can still see, if the token if the protocol is still paying out token incentives, and in often cases, those that are still like paying out incentives are the ones that are doing better, just because there's more activity that's being generated on the platform. A lot of it's driven by the desire for users to like get percentage of these tokens. Now, whether or not this is sustainable, like obviously there's only a certain time where whatever allocation that they have to liquidity mining incentives runs out. But the key point to make here is that there's that cold start problem associated with any marketplace, right? So you want to get to a point where you have enough revenues that are being generated by the platform fees that can help sustain the token incentives that are paid out to like users. So it becomes like self-sustaining. But I think that's the key point I wanted to make with the slide, and something I look for when I look at any protocol these days.
Interesting. So would you say that, so just to, I guess, to reiterate, the competitors of Maple are paying out more incentives still, or what was the point there?
Yeah, they're paying out more incentives. That has helped them to achieve higher users, and their FDV at this point is also higher.
Okay.
However,
So,
I do think that Maple's underwriting model is probably better. They've had more delegates that are on the platform, and I think that's why their TVL is also higher. So it is kind of like a combination, but
yeah, I mean, basically you're aiming at who's truly creating something useful for the market, right? Because if you if they have a product that institutionals want to use regardless of incentives, then that means there's value in it for them, right, to use it. And yeah, and so I guess that's kind of, that's one of these general issues in crypto. You can incentivize, or you can essentially pay people to use your product for a while, but eventually, no matter what, eventually the incentives dry up, and then you see what actually sticks, right? So a lot of growth looks like growth and feels like growth in the beginning, but as soon as you stop paying your users, they go away. Yeah, makes sense.
I guess I'll go to the last slide. Talk about value creation and value capture. And I think the one that I wanted to kind of focus on is the value creation. Like, why is under-collateralized lending important? And then we kind of we previously mentioned, I think Pranav asked a question, like, retail gets access to the corporate credit market. That means they get higher yields. So a different risk profile than over-collateralized lending, but still safer than going to degenerating into like a yield farm or buying altcoins, right? So that's just important that it gives retail options on depending on the risk profile. I think under-collateralized lending is a good option for retail. Number two, I think it also grows the overall like TAM of DeFi, right? Let's say one day Maple Finance is able to extend not only to market makers or trading firms, but to fintech companies, to small businesses that are deemed risky by the banks. That hugely increases the overall pie of DeFi, right? It makes it more useful than just over collateralized lending, where you have everyday retail users or companies that are just borrowing just for the sake of like levering up or like speculating. So this the real use case in the protocol. And I think the last point is like true credit creation, right? With when businesses are able to take on loans, that enables them to grow. So it's good for the economy as well. A lot of every economy is like dependent on credit to grow. So I think for crypto to grow as well, like debt financing has to be like a key primitive that is safe and transparent. And then I guess we talked about it earlier as well. Like just because it's there's still a lot of like centralization and points of risk, but underlying blockchain means that it's transparent, right? People can see where the money is being sent to. They can see who's taking the money, and it just makes the underwriters more accountable. It's also faster because this faster settlement. A lot of it's automated, so just because it becomes cheaper and becomes faster, I guess, to underwrite a loan. So that's value creation, and why like underwriting, like having a platform like Maple makes sense, and it's important for the overall economy. Value capture, I think we talked about it in previous 2 slides, but how they're doing it is really through revenue sharing, right? They use 50% of revenues to buy back Maple. They distribute to stakers. I guess holders of Maple token can also earn like a percentage of interest income by taking on additional risk to provide insurance against loan defaults. And then last part is like the utility around like features. Right? So if you're a borrower, holding Maple is probably something you want to do to be able to access like discounts on a borrowing fee. So yeah, that's kind of the main points I wanted to make today. I guess I can open up for Q&A.
Yeah. So again, feel free to request to speak. Otherwise, also beyond this space, if you want to ask John a question directly, you can DM him here on Twitter, or you can find us. You can join our Discord. Link is in our bio for Tokenomics DAO, and you can talk to us there. You won't just find John, but lots of people who are super into tokenomics, and we have discussions like this all the time. Pranav just had a question again. Is he up here? Yes, he is. Okay, so Pranav, if you
Yeah.
want to ask, go for it.
So how about whether we like doing something for the Maple token holders? That is, some sharing the revenue instead of just by staking, only for stakers. How about every token holder gets a dividend or an equity model based token for this protocol? So the revenue from to the protocol is distributed among the holders rather than just stakers. Will that be a viable
Well,
model of approach?
Well, staking in this context is really just holding, right? Because this is not like an app chain. Like staking does not help to secure the network. So really, the staking mechanism is just to incentivize like token holders to like lock it up.
Yeah, but the
That's
circulating
really,
supply is getting, I mean, the circulating tokens get, like changed, right? Wherein when token holders get the equity model, something similar to what we do in normal stock market or anything. So you hold it, you get a dividend from the protocol, from the company, right? That kind of a model for this protocol.
well, you just mentioned that comparison of the stock market. I think that's kind of the answer here. Like the key point, like in my opinion, this is all just legal arbitrage to prevent Maple from ever having like a point of like legal risk, right, in the future. If we're paying out dividends directly, then that is like a direct violation of the Howey test. The Howey test is basically an analysis done by the SEC to analyze if a token is like a security. And a key point is if there's an expectation of profits, which is definitely the case if you're paying out a dividend, then it really makes Maple just like a security.
Okay. So those
That's
kind of
probably my guess on why they don't do that, but I don't know, Lovis, if you had any, if you
no,
agree.
might be they don't do it's different, but still, will these kind of models be efficient enough? Why I'm asking this is a selfish reason because we are actually developing something not exactly similar, but something really common into the DeFi space. So that's what my objective is all about.
The rewarding people to hold the token and calling it staking is somewhat of a misnomer, right? Is what John pointed out. So the proof of stake on a layer 1 level works a little different, right? You put capital at risk, and if you introduce faulty transactions into the chain, then you get punished, so money gets taken away from you. And so in that scenario, staking, you're actually providing value to the network, right? You're providing security, which at the end of the day, trust and security is the product of every layer 1 blockchain. But in the case of so many DeFi tokens where staking just means holding, we've seen, and I mean, like Tokenomics DAO, we've had discussions about this quite a bit. And we've seen that is a very weak incentive if your goal is price stability, right? Because if something happens, if anything happens, really, people will unstake and sell, and it doesn't really stop. It doesn't really stop that at all. So it doesn't seem to be just empirically, it doesn't seem to be a very strong mechanism. You can probably enhance this by saying, okay, rather than giving you more of my token for holding my token, you could say, well, I'll give you USDC or ETH, right? So you have a kind of a diversification in that, but that makes this runs you into this problem of being regarded as paying a dividend pretty much immediately, and that's when then you trigger the problems with the SEC potentially. So I think everybody would like to pay a dividend, like treating it as an equity, but and honestly, all that's missing is a simplified registration process, I guess, with the SEC. Because at the end of the day, I don't think it's really a bad thing to issue a security. The problem is legal compliance, right? You have to then do quarterly reports, and like there's a whole bunch of work and effort that goes into that. And I think common wisdom is like if you have like less than $100 million in assets or something, then it's not worth it because there's so many fees, legal fees and stuff associated with doing all these filings. But I think as protocols get big enough, then why not? I'm excited to see some protocols going that route, which I'm sure isn't far off.
Yeah, I think the one caveat, or I think strategy that a lot of protocols are using, are going into like the app chain model. So you kind of see this happening with DYDX. A lot of people speculate that it's due to the legal arbitrage, but essentially, if you're like an app chain, then you need stakers to help to secure the network, right? And then so if you pay staking rewards to these stakers, who are really just users of the protocol, then you can argue that there's no expectation of profit. Like you have to pay out those staking rewards to secure the network. And so I'm pretty bullish on the app chain, like the whole Cosmos ecosystem, and a lot of DeFi products that are being built there as well. That I think have a better value capture than your typical smart contract protocol that's built on layer one.
Oh, well, honestly, if you check about DYDX, what they do is off-chain and on-chain aggregation. For
Yeah.
that, if they go to their own chain and all, app chain concepts, it will be huge, like very mempool transactions, and also it is like cliche. But if they have in a public blockchain, it's different, right? So, but still, there are plus points, and at the same time, there are negatives in it.
Yeah.
So I mean what I'm saying is, for a staker it is a locked up period, right? You do lend your securities for some time in the stock market. I mean traditional trade markets also for these futures and options. But here what I'm trying to say is, for regular token holders, it is not the capability that he's not ready to stake or something. Staking means it's a locked up revenue, right? So for that, I mean, direct dividend model will be suitable, is what my whatever. I mean, it's
Yeah.
you can correct me. I mean, I might be wrong also.
Yeah, that's a good point. I know we're out of time, Ovis. I don't know how long these sessions really go, but I guess if anyone else had questions, happy to answer us, having go over.
Yeah, I mean we're at an hour. We can keep going a couple more minutes.
Okay.
But yeah, otherwise, if we, like I said before, if you guys want to continue the conversation, feel free to take it to DMs or and get on our Discord. Pranav, I don't know if you're on our Discord yet, but if you are working on a concrete tokenomics implementation, definitely join us, and you can ask questions and have discussion on Discord server as well.
Yeah, I'm already on the Discord, and I think tomorrow I have a meeting set up with your team, I guess so. I don't
Okay.
remember the name of the person.
Okay. Yeah, no worries. Sounds good. Cool, guys. Yeah, if there's any other questions, otherwise we can also wrap it up. But yeah, John, thank you absolutely for this presentation. I thought it was very interesting. Oh, I did have a question. So, and this might have been me not paying attention this entire time, but I don't know. I don't think so. But so on Maple Finance, the lenders are institutional, correct? But but it does say in the value creation, retail gets access to corporate credit markets. So this then obviously means on the kind of capital provider side, right? So people can. So what is that called? So you can become the borrower is institutional, right? But the lenders can be retail. Is that correct?
Well, yeah, the people who are providing capital are either it's retail or institutional. Doesn't
either or.
The point is, yeah, anyone who deposits the capital can be anyone, but probably mostly retail. And then the underwriters, these are professional credit people that come from a professional credit underwriting background. They get onboarded onto the platform, and they're the ones that are issuing loans on behalf of the depositors.
Okay, so there's but do the depositors have any kind of pull in who the underwriters are, or any? No, probably not, right?
No, but it's clear when they deposit, they can choose to deposit in certain lending pools, and then there's the these lending pools have a description of who the underwriter is, their strategy, whether or not they're trading, they're underwriting to, let's say, fintech firms only, or maybe only delta neutral trading firms, or let's say only market makers. So the users have still a choice on how the loans get distributed. Right? It's an opt-in model versus I'm going to deposit into the Maple Finance pool, and then I'm not sure how my money gets lent out. It's I think the users know or have clarity on how their funds are being lent out, if that makes sense.
Yeah, but is this okay? That's really interesting. And so from There was just headlines last week or this week even that a big German company, Siemens, issued a bond for 60 million euros, and some bank picked it up, and they did that whole transaction on Ethereum, but I think it was on Polygon. So like they were like, oh, processing fees for this whole transaction was like $1.20 or something, and they were like, whoa, how cheap. So I'm saying this because like, would Maple Finance be able to, like the technology, would that be able to support something like a direct bond issuing I mean, because essentially that is just Siemens getting a loan, right? So would they be able to say, hey, we want to borrow 60 million, our risk profile is pretty clear because we're public, been around for how many hundreds of years, and then retail could theoretically lend to them, or does this go beyond the scope of Maple?
That's a good point. I'm not so sure, but I would imagine that if they're offering bonds, then that is a very clear, like, different proposition, right? And
right.
Then it's clearly you're clearly a platform offering securities.
Right.
I know there's a protocol called Ondo Finance, and they essentially offer like treasury bonds but on chain, and they've had to like go through like the registration process for securities. So I think Maple Finance is more like focused on like facilitating lending.
Private lending market.
Yeah.
Okay. Cool. Yeah, it was just a thought that popped into my head. Kind of off topic. But yeah, anyway, okay, guys, anybody else have a question? Be it off topic or on topic. Otherwise, we'll shut this down. And I thank all of you guys for your participation. And yeah, see you guys around Discord and Twitter. And thank you again, John, for the early morning presentation. It was very good. Really enjoyed it.
Appreciate it. Thanks, guys.
Thank you, everybody. Have a great day.